For those that watch us, we always talk about this average chart and putting this all together. And I really think this is probably the most important chart when you're looking at how are we going to look going forward. What is the trend that we're seeing? And I was actually having a conversation about this in the BI Energy Exchange for those that have Bloomberg. I am Cato or Cato, however you want to describe it. There's a long story behind that and my dislike of avocado toast, or at least the stupidity of it and the cost of it, which then earned me the nickname of avocado, which has been shortened to Cato or Cato, depending on how you want to pronounce it. But when we're looking at this number, it's important to look at the trend, where one of the things we've been talking about is we expected to be between really just below that 15 million barrel a day line. And we were expecting about 14.9, and right now we're trending at about 14.5. Now, that's as we continue, it just means that we're going to have to take our estimates down a bit. Because the 4-week rolling average, which is that 2022 average, and how we're calculating it, it's going to be difficult to move that needle as trucking continues to slow down. Passenger vehicles don't do all that much. It's still, again, it's not that we're getting this huge demand destruction, because that's not how things operate in the U.S. Trucking is still above historics going back to 2014. It's just well below 2021 levels. And then when you look at where we are today in terms of the average, given, you're still above 2020 when you're looking at, but 2021, trucking was the driver. Trucking getting running gangbusters, and that was really the driving force, even though you had the continuous slowdown in jet and gasoline. Now you've had an increase in demand of jet and gasoline, but you're getting a big slowdown in diesel when you're comparing it to 2021 levels, resulting in this more depressed backdrop, which is, as we've been saying, not anything we expect to change. And we still hold to the fact that July 4th was the high. When you look at that peak in the white line, we don't expect to get back to that level or achieve that rate for the rest of the year. And that's where we're going to see some of these overhangs as we continue, as the economy slows, which is going to bring down trucking. But as we say that, the comment is, well, but diesel prices aren't dropping that much. And it's like, yes, because there's a storage problem. It's not that demand isn't slowing. It's that the shortfall in storage is propping up prices, which means, in what we described last week, you need a bigger demand response or a bigger demand shortfall to see that adjustment. So if you just think about a typical economic metric of finding equilibrium in a supply-demand curve, if supply is lower, and in order to get the price that you need to incentivize demand, you either have to move supply up or move demand down. And again, because we have that stickiness on supply with short inventories, problematic yield when we're looking at the crude runs and what kind of crude is available, that's going to promote or at least prolong these elevated diesel prices even as gasoline continues to falter. So now when you look at distillate, this, again, coming back to what we've been discussing, distillate had a drop of 2.4 million barrels across the board, with the 5-year average now 35.8 million below the 5-year, with Pad 1 carrying over half of this. So when you look at Pad 1 is 22.4 million barrels below the 5-year. It's the lowest level of storage in our recorded history. So again, this is a huge problem, especially as we're supposed to be building heading into the winter months, because heating oil is still the main form of heat that is generated in New England. And without this availability, you're going to see, again, prices being supported, because heating oil and road diesel are the same. They are competing against each other, which is why we're going to continue to see these elevated prices. But as we've been saying as well, imports were going to increase. We're going to pull more in from both the Middle East and Asia with an increase of 110,000 barrels a day, bringing us 93,000 above the 5-year. And as you can see, it is mostly weighted towards towards Pad 1 as we continue to have these counter-seasonal draws. Now, just putting into perspective in terms of Pad 1, not only are we having a slow rate of change, but we are now declining when we should be building at this point in time. And it's just widening the gap in terms of where we need to be, which is going to create a huge problem on the heating oil front. Pad 3, fairly stable. It's still on the low end, but again, it's skewed a bit by 2020. But you can still see that there's essentially just going sideways. Exports continue to be elevated. That's how they're managing some of this, putting what they can on Colonial, whatever they can on Jones Act vessels. But realistically, it still makes the most sense to export internationally as it heads into Latin America. And that's going to continue to be one of those driving forces on the disty side. But we'll talk more about exports in segment 3. When you look at demand, again, as we've been saying, it's just going to be just below the 5-year average. We don't see too much movement. It's not going to make new seasonally adjusted lows. It's just going to stay in the lower end of that cloud, just below the 5-year, but above the bottom of it, and just bump along and follow those seasonal patterns. And the reason why is because, again, the trend is down. We continue to edge lower on trucking demand. But when you look back, it's still even above the peak that we had in 2018. So again, you're coming down, but against the historics going back from 2014 to 2019, we're still elevated. But when you compare it to where we've been in 2020, in 2021, especially 2021, when you look at it, it's still massively off that peak. And that's where we're continuing to see some of these slowdowns, which is going to weigh on some of the, I think some of those bigger pieces when you look at the diesel side. But when you look at diesel, this is the downward pressure on pricing. And then inventory and availability is the upward pressure, which is why demand is falling, so prices are falling, but because of that underlying pressure, you're still seeing prices come down, but not at the same rate as gasoline, which is the one that is coming down much faster. U.S. rail traffic, nice increase, 3.6%. Grain, not surprising, grains had a big increase of 18.3%. Coal is going to continue to be elevated versus even 2021. Motor vehicle, intermodal had a little bit of a bounce, only 1.9% below last year. And again, we just expect that to be about 3% below on the intermodal side as the rail traffic averages out, because as inventories have built on the consumer side and at the in terms of wholesale side, you're seeing some of this slowdown on the trucking because people don't need things as quickly, so they can wait for rail. It's cheaper. Instead of getting one cargo at a time, you can get 5, 10, 15, depending on how many containers you own on that rail. So again, that's something that's going to be the case. But imports in general are slowing. And when you look at just coming into LA, you get an idea on that slowdown in terms of previous year and the previous week, where we're just not seeing those elevated levels. And we, as we've been saying, we expect that to be the case as imports remain lackluster, driven by slowing internal demand, but also as we continue to see slowing external, or I should say global trade. Now here, when you look at temperatures, we still remain above average pretty much across the United States. So when you look at this, it's going to support natural gas consumption. One of the things that we've been saying is given the shifts in supply and demand, we don't expect this huge push to $10, $11, especially given the Manchin bill, that is as it's being called. When you look at getting Mountain Valley Pass MVP approved and trying to push that through, you're gonna help bring 2 BCF down, but it's going to be absorbed based on the LNG capacity that's going out. You have Port Arthur that's being built. You have Golden Pass that's being built. That's going to, again, just kind of balance things back out. So it's just MVP getting passed helps bring more natural gas down. But there's also more demand and there's more LNG. So we're just keeping ourselves fairly fixed. Obviously, it's highly volatile, moving anywhere 50, 60 cents at a clip. But again, you're just kind of getting some of this stability that we've been seeing. Now, when we look at gasoline had a small build of 160,000 barrels. That's 8.9 million below the 5-year. But when you look at the shifts, Pad 1 is the main driver of the drop, down 12 million versus the 5-year average. But when you look at Pad 1, it had a draw of 1 million with everywhere else having builds. And Pad 3 actually above the 5-year average. And here is another way to look at, how comps get easier. Look at that dotted line, and as it normally trends down, and we're just going sideways. That means that as we go sideways and the cloud shifts down, that line is going to run right into the top of it, and that's where you're going to see things be fairly normal. Imports starting to increase a bit. The ARB has been, even though you would assume it would be wide open, it's actually been a bit tighter due to shipping costs, shipping issues. The Rhine is actually getting to such a low level that it's coming up to just being closed in general, which is always a big hiccup when you're looking at the movements of crude and whatnot. And we'll talk more about that in the Econ show tomorrow. But here, Pad 1 still had imports of 508,000 barrels, slightly below the 5-year by 189,000 a day. We do expect that to grind a bit higher, but still, given the slowdown in demand, we don't see a huge surge in imports. It'll just be above where it's been because it's been fairly slow coming up to this point. Now, when you look at total inventories, again, these steep drops, when you look just giving the rate of change idea, the rate of change of inventory drops or declines accelerate at this point in time. And instead here, they really just, for this year, it's just going sideways, which without getting that rate of change drop or drop at all, that's going to, again, run right into things. As the mobility index continues to be below the second quarter levels, here you can see China continues to slow. We actually see it below 100. Again, that's just a matter of when this was clipped. Google Mobility Index, you can see some steady state in Asia, but as we're going to talk about in segment 3, we're actually seeing Asian demand now slow, which is pushing more gasoline into both Fujairah, obviously Middle East, and Singapore storage, which is indicative of that drop in Google mobility within the Asian continent. And then when you look at Europe, again, kind of finding this steady state, America's about 10% below. We don't see that changing, but really kind of pulling down Asia, which is going to draw down the global mobility to about 95%. And I think TomTom is indicative of kind of where we see that going and a little bit of that leading indicator. When you look at pricing, just going back through 2007, you get an idea of where prices are right now. Again, diesel still remains at an elevated level at $5.23. It's actually below where we were expecting. We thought it was going to hold in a bit higher, but it continues to trend down. Then when you look at gasoline coming further, that $4.16, and it'll likely be by about $4 as we get into really the next week or two. We should see that next 16 cents come out. Now, when we start looking at blending components, blending components in general had a small build of 110,000 barrels. But remember, blending components is an indicator of kind of where storage was going. So last week we had a draw, but we said, look, blending stocks the draw wasn't that strong. We see some of these shifts. And again, this is just playing out. Now, it's still 4.8 million below the 5-year, but remember, gasoline is 8.9 million below the 5-year. So, and when you look at this, it's just blending components has gone sideways, and you normally have a rate of change down looking at the last 7 years, and we're just not going to get that. So as we get into September, we're either going to be, we're really realistically going to be above the 5-year average. And that's what we've been saying is as we look forward, as the comps get easier, it's not going to be all that bullish, which is why we've been saying long diesel, short gasoline is really that really good trade. And we think that still holds true as demand for gasoline breaks through the 2020 lows. And we expect it to bounce back. It's not going to reach the peak even that it came from. It's going to just continue to fall well below even the 5-year average. And this is just looking at the 10-year average, which you can see it's well below as well. And here, when you look at just activity remains sluggish, and we just don't see that shifting, especially as we come to the end, because this is the first 2 weeks of August is kind of like the last piece of vacation, and then as we come into August 15th and that week, you typically have the South, the West Coast, they start to go back to school, and that's when you start to see that peter off a bit faster. Propane had a build of 1.82 million, still 7.1 million below the 5-year. And as you can see here, the rate of change is right in line, slightly below where we are, but we're right where we've been in 2021, 2018, 2017. So still in a fairly bullish backdrop. When you look at jet fuel is right in line with the 5-year, in terms of a build of 1.49 million. And then demand dropped just below 2021 levels. Again, we just see it being right here in that level of between 1.45, 1.55, and that's where we see things. And the reason why is because when we compare it to 2021 levels and 2019 levels, we're going to continue to sit right there. And you can see the drop starts in the next week or two. As you see that come down, and it happened in 2019, it happened in 2021, and it's just going to happen this year as well. So again, filling in that void between 19 and 21 levels. Passenger schedules, 12 weeks ahead is 0.21% lower than the previous week, and nothing really changed. We just see airlines being fairly consistent, which is, again, indicative of where we see demand. And then open table, not much to say, better than the previous, anywhere between 3 to 10% better. And just given, how people are eating out around the world, even as prices go up, people still want some semblance. So the staycation is a bit more tolerable if you get to go out to dinner every night. So as people cut back on broad spending, you're still seeing some of this hold in, which is a net positive for restaurants that have struggled through the pandemic. But again, sometimes it can be a bit misleading when you're looking at demand in general. But that's why we talk so much about it in the macroeconomic show, or the economy show, which we'll film and distribute tomorrow. So that's what we have in segment 2. In segment 3, we're going to go again bigger in terms of the global market and how things are building out.